Hello everyone and welcome again to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, firstly, let's take a look at the economic calendar, and as you can see, it is a bit of a quieter trading day in terms of key economic data. Obviously, overnight, the Chinese trade data was of great importance. We did get some disappointing figures here, but I think it's worth taking a couple of things into consideration. Firstly, this is a one-off figure. We have seen improvements in the data. We have seen quite steady exports, and while exports have been declining, the economy, of course, is experiencing a bit of a slowdown. So this isn't a great concern. We haven't had, and we're not expecting, a decline to the amount of 10%. Also, imports as well were weaker than expected, but they have been largely improving. So I think one thing here is this is a disappointing figure. We do know that the Chinese economy is experiencing a slowdown. It has actually had a bit of a rebound this year, but most importantly, it's a one-off figure. I think we need to see 2 or 3 figures before we can start making a real judgment, and I think that's why the markets haven't necessarily responded too badly to this so far today. I think they'll want to see more evidence that we're seeing a more significant slowdown in China than people had anticipated. And you'll also see there that the figures are reported in dollars and Chinese yuan as well, and from a percentage perspective, a certain amount of it is attributable to the fact that the Chinese yuan depreciation, which has been widely broadcast as well. The figures still aren't great, of course, in terms of Chinese yuan, but they are a little bit better than these current figures would appear. The initial jobless claims was largely in line with expectations, unchanged from last week. But again, while this is a medium volatility figure, for me, it's more of a low volatility figure. You very, very rarely get any impact to this number in the markets. One, because it tends to come in line with expectations, but two, because I do think it's less important at the moment, given that unemployment is already so low. We'll come back to the key things to come to later on today, although I will touch on the fact that we do have 2 speeches today. I should say we've got 2 speeches from members of the FOMC next year, and that is Patrick Harper and also Neil Kashkari. Both of them are, that is the presidents of Philadelphia and Minneapolis. Both their comments are going to be interesting, and because they do still take part in the meetings, but more importantly, they are both voting members next year. So while we are expecting a rate hike in December, we're also expecting more rate hikes next year. So we want to know more about the views of the people who are coming into the FOMC and who are going to be voting members in 3 months' time. Now let's take a look at some markets, because the markets are actually looking quite interesting today. Actually, before we do that, we do have a couple of key points to touch on. First one is the FOMC minutes from last night. There wasn't really too much to take away from these. I think the biggest takeaway has been the fact that a number of policymakers do see recession risks associated with not raising interest rates, and I think that's a key point. That prompted 3 members to dissent on the meeting this month, but there does appear to have been a number of other members which were very close to voting for a rate hike, and it looks likely that they're going to later on this year, barring any catastrophe of any kind, which in the current market environment you wouldn't write off. The Chinese trade data we've already touched on, but finally, I think this is an important note, especially for oil traders out there. Was reports today that China imported record volumes of crude oil last month, eclipsing the US for the 3rd time this year, and up from 18% a year ago to 8.04 million barrels per day. I think this is very important because we keep talking about there being weak demand for oil and oversupply. Now, we are seeing efforts, whether they are going to be fulfilled or not, to try and stem the supply from OPEC and Russia and other major oil exporters, not including the US, of course, which is seeing the oil rigs coming back online gradually since the middle of the year, and this could pick up now that oil prices have gone above $50 a barrel. But we don't hear enough about the increasing demand, and I think this is one important point here. China is one of the world's fastest growing economies still. It's still the world's second largest economy, and the fact that we're seeing volumes of crude oil up 18% on the year and eclipsing the US as the largest importer of crude oil, I think is a very significant event. Now, whether this can be sustained or whether this is being driven by the fiscal stimulus that we're seeing from the government is yet to be seen, but I do think this is quite significant. Now, let's take a look at the charts now. we could start with the oil charts actually, because this ties in with what we've got being released later on today as per the chart. We did see the oil rally up towards this $53 in Brent crude, trading now in Brent crude at 1-year highs. And then it's come back, and we're seeing it find support now around this $51 a barrel level. This was resistance from throughout June and also in August. Now it seems to have settled here ahead of the EIA crude inventory numbers today. The API data yesterday would suggest that after 5 consecutive weeks of drawdowns that we're about to see an inventory build. Should that happen, then we could see a bit more downward pressure on it, which could bring it below this support and see it testing $50 a barrel once again as it has previously. However, another drawdown, which would come as a shock at this stage, could prompt another rally up in this pair and could see it pressuring $53 where it found resistance previously, but also the high 53s as well, maybe 58 to 54, 53.80 to $54 a barrel. WTI, I think, is even clearer again, because we actually ran into resistance at the June high before retracing back now towards the June resistance levels, which has now turned support. And again, in the same way, a drawdown, an increase in inventory as expected, may see it come back and test these 48.70s. But if we do see a surprising drawdown again, then that could see it testing the 51.36, and then beyond that, we could see it moving on towards these 53.50 to 54 levels, which is then again multi-year highs. So worth keeping an eye on that inventory data, which is being released a day late because of the US bank holiday and at 4 o'clock as opposed to 3:30. The final charts I want to look at are indices, because I think indices are looking very, very interesting right now. Very concerning, actually, because we have seen signs of these indices topping out recently. You can see that the most recent highs that we had in the FTSE appeared to show it taking off. We saw higher end energy prices and we saw the weak pound spurring it higher. But then the most recent attempt at making a high failed at the high level and came back towards this 7,000 level, 7,000 being a psychological level, but also the most recent support. Now, the fact that we failed at the same high twice meant that we had a double top forming. Today we smashed through the neckline of that double top, and we've continued lower towards 69.50. Now, that's the next major level of support. But what I think is also very interesting is we've got this trend line going back from June this year, number of touches on this trend line, and it appears that we're currently smashing through that level as well. It'll be interesting to see if we get a close below here, but the fact that we've broken below the double top neckline, based on the rules with regards to double tops, you'd typically expect to see a move the same size of the move that we saw from the top of the double top to the neckline produced again, which would take us back to around these 68.75 levels, which would be well below the trend line and could suggest we're in for a bit of a rough ride in the FTSE following what has been quite a strong rally since the Brexit vote. I also want to highlight you to the weekly chart on the FTSE, because we had this very strong rally last week before we ran into the high, which was the highs, obviously the all-time highs in the FTSE. And since that, we've seen a lot more negativity. Now, it's Friday tomorrow. If we see a weekly close below that, say, next 6,900 level, which is the opening level of this, that means we've seen a failed attempt to make a new high on 2 occasions. It would mean that we've seen a full engulfing of last week's candle and the break of the trend line, which started since the Brexit vote. So I think that would be a very bearish signal and could maybe suggest that we're looking back towards these 6,700 to 6,650 potentially, 66 to 6,700 potentially in the short to medium term, or even could be more concerning than that, maybe looking back towards 64, 6,500. So I think it's potentially looking quite damning in the FTSE, but again, that's going to depend on how the next 24 hours pan out. We've also got the US 30, or the Dow as it's called. Again, this is looking very toppy at the moment. The fact that all the indices are pointing towards the same thing is again another major concern. We've had this string of lower highs in the Dow, failed to make new higher highs, failed to make new higher record highs, we should say. And now we're testing these lows again. Now, we did have this floor around 18,000, which again is a big psychological level. 18,020, 18,025. This had provided a floor really over the course of the last month or so. But we broke through here again today. Another very bearish day. The US markets are poised to open much lower again today. Broad-based losses, so there doesn't seem to be anything particular driving them. But now we're seeing it drive below that 18,000 level by the looks of things today, which could open up and move back towards the 17,950s or 17,900s, the next two major support levels. If we see a weekly close below there, things could start to look very messy for the Dow. And the S&P 500 looks equally worrying. We've got, again, the lower highs being made off the back of record highs being made in the S&P. We've broken below the moving averages, and again, we're approaching this major support zone. Now you're looking around 2105 to 2115, call it 2100 if you wish, which would be around here, and a break of these levels, I think, could signal a lot more difficulty to come. You look at this area of support now, it's not only the most recent lows, you can see that ever since really July last year, we've seen this steady stream of resistance being found around these levels before we eventually broke above, so a break back below could strongly signal further difficulties to come. So very interesting times again for the markets, but I think it could become tumultuous if we do see some of those moves materialize into something much more concerning for the indices, which could prompt a lot more risk aversion in general. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.